Passive's done better in the last 12 months because the market's just gone like this, right? So, a rising tide lifts every boat. And so the passive funds have actually done very well in the last 12 months because they've ridden the market up. But can they maintain that? If the market goes through a downturn, as an active manager, we're trying to manage the downside, right? So it's easy, not easy, but it's easier to make money when the markets are on the rise. For us, it's about picking those individual companies, picking the winners, and managing the markets on the downside. And that's really where an active manager will earn their fees. I think one of the other big things for Milford is that we're all invested in the same funds. Every single staff member at Milford, all the investment team. We can't have our money anywhere else.
Yeah.
And so, there's quite a bit of motivation to
we got to get this right.
We've got to do well for our clients, but we've got to do well for us. And it's our mums and dads and aunties and uncles that are in there as well.
Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair. And today we've got Murray Harris, head of KiwiSaver at Milford, here to talk about active KiwiSaver versus passive.
We're back in your life. Murray, welcome to the pod.
Thanks for having me, guys.
No problem.
So, head of KiwiSaver at Milford. So active versus passive going to be a very interesting topic today. Just before we get into it, in terms of Milford on their KiwiSaver, just give us some numbers. How many KiwiSaver clients do you have? How much total investment is there?
Yep. Well, KiwiSaver clients are about 125,000 in round figures. So we're not one of the biggest providers, but we like to think of ourselves as being a really high quality provider.
Yeah.
And funds under management, nearly 10 billion. That's my next goal. I'm trying to get us to 10 billion, soon.
Yeah.
And look, we've grown rapidly over the last 3 or 4 years because we provide great investment returns, excellent service, and access to good advice. So we've got our heads down trying to do a good job for our members and to keep growing the business.
Nice. You find that extra couple of $100 million down the back of the couch to get you to 10, wouldn't you?
I wish. I wish it was that easy.
Yeah. Well, I was going to say the market jump over the past 12 months will help you get towards that 10.
It certainly has helped. Yeah, there's been a good, decent market uplift in the last 12 months. And look, we are onboarding a lot of new members because, when markets are buoyant, members feel more inclined to want to transfer. Oddly enough, they don't want to transfer when markets are down.
Yeah,
and in fact, that might be the best time to transfer. So.
Yeah. So I'm really glad to be doing this topic today because active versus passive comes up a lot of the time. If people are YouTubing financial education, it'll certainly be something that'll come up. We've had Dean from Kernel, Sam Stubbs from Simplicity come on the podcast, but we haven't had anybody really represent the active side. Yeah, and I think there's that saying that like a little bit of information is like more dangerous than no information. So it'd be good to kind of talk about both sides.
Yeah.
So where do we want to start, Mike?
I reckon let's go. Let's break it down for everyone, right? What is active management and what is passive management? Just in a nutshell.
Yep. Well, look, I kind of start by saying both are very valid ways to manage money, right? And you tend to find that there are proponents for one or the other. With active management, as the name suggests, you've got an investment team, which is normally a team of, highly skilled professionals that are well trained, actively choosing every investment that goes into a fund or a portfolio. And in the case of KiwiSaver, it's the KiwiSaver fund, right? So you've got an investment team who's doing bottom-up research on each individual security and investment that goes into those funds, as well as making a decision around which asset classes to be in. So how much do we want to have in shares versus bonds versus cash? And in fact, that actually can be the biggest lever rather than the individual securities that you choose. And so an active manager is trying to pick the winners and avoid the losers, because sometimes the best decision you can make is where not to invest, not where to invest. In passive, as the name suggests, there is no active investment decisions being made. So it's a passive investment. Generally, the investments are made in an index fund or an index tracking fund. People will be familiar with those terms, or sometimes an ETF, an exchange traded fund. And those funds will just have exposure to the entire market. So let's say it's the US share market. There'll be an S&P 500 or a Dow Jones index fund, and it will have exposure to every single company in that index, regardless of whether that's a good company to invest in or not. And they tend to be because they're passive and they don't require that active management and they don't require a big team of people to do research and make decisions, they tend to be lower cost. Obviously, active managers, there's a cost to hiring that team and having those people do all that research and then do the trading. And so active funds tend to be more expensive than passive funds. But an active manager is trying to outperform the index. That's our goal. Otherwise, why would you hire us? Why would you pay the extra fee?
So that's, Milford doing kind of active, more passive providers. What do the banks do? Is that like a hybrid no management model? Where they just have no return
They've
whatsoever?
moved more and more towards passive, right?
Yeah.
So I think the banks, they probably like had an idea of who they were in the KiwiSaver space. Obviously, like if you look at flow of clients, more and more people tend just to leave the banks over time, which is, if you look at your flows, I remember sitting in meetings at Westpac and looking at the flows of KiwiSaver, and Milford was just eating up market share. So I think they've just gone passive is probably like the best proposition that we can offer.
I think where you want to keep costs down, increasingly we've seen some of the larger providers move to a passive strategy. And for some of the providers, they don't have in-house investment teams that are making those investment decisions. They would rather outsource the investment management to a professional investment manager, probably overseas, and more likely passive, just to keep those fees lower for their members.
So when it comes to the active management component, are you active across all asset classes, or do you particularly focus on Australia and New Zealand and maybe outsource a little bit more of the international side?
We are active over every asset class. So we run every single asset class internally. So we've got a team of about 40 investment managers, investment professionals, analysts and portfolio managers based in Auckland and Sydney. But even for our global decisions, our global team, they're on calls. These guys work all sorts of hours, right? Because they're on earnings calls, they're on calls with companies we're looking to invest in, they're doing their research. So if you're calling a company on the east coast of the USA, you're doing that at maybe 2 or 3 in the morning. They have a company call, they might have an earnings announcement. They're making an announcement to the market, which is in the US time zone. So, we'll have our analysts and portfolio managers up all hours of the night listening to those and gathering that information and data. And then they have to go and see those companies. So they'll do that through either a big company conference or a broker conference where all those companies come together for 4 or 5 days, and you can see the whites of the eyes of the CFO and the CEO and ask all the appropriate questions. And then we'll also go and visit those companies and go and look at their operations and look at their business internally. And, part of the process is actually talking to everyone in the business. Is this a good company to work for? We'll talk to people on the factory floor. We'll talk to people in the head office. We'll talk to their competitors. We'll talk to their customers. So you can build up a picture of, is this a good company to invest in or not?
Yeah, you mentioned, Murray, opposed to like looking bottom up, there's the impact of the macro side as well. I'm keen to get your thoughts on a couple of things. One is obviously the markets have performed incredibly well. Are you holding on to? Are you starting to hold on to more cash, or are you just your asset allocation is kind of staying towards its target?
Yeah. Well, look, with an active manager, of course, you've got that ability to pull a big cash lever. And at Milford, we, are particularly active, and some of our funds are absolute return type funds where, we're not trying to match a benchmark. We're just trying to generate a good return over time, but protect on the downside. So during COVID, we were able to raise our cash levels in things like our active growth fund. And, in normal times, that cash level might be at sort of 5 to 10%. We were able to raise that to 30% so that we can protect the downside. And so you're making those decisions all the time around, what's the appropriate level of cash versus bonds versus equities. And at the moment, markets have done very well in the last 12 months. But there are, some companies are very highly valued because as an active investor, we're not investing in the market. We're investing in individual companies. So you've got to be out there, and everyone knows about the Magnificent Seven, right? So those 7 companies that have driven pretty much all of the market rise over the last 12 months, your Metas, your Amazons, your Teslas, etc. We've had exposure to some of those, but some of those companies we think they're just too expensive. So why would you put money into a company that actually has more chance of the price falling than rising? And so we're out there looking for the next winners and trying to identify those and put money into those and then ride those up over the next 2 or 3 years.
That's interesting. So I was going to ask about that, like especially like Nvidia is probably a big one, like the AI movement. So opposed to going for those that are quite overvalued, like I guess what is your stance on from an investing perspective? Like AI, are you looking for the next winners in the space, or how are you treating it?
Yeah, I mean, AI is a really interesting space, right? And look, there's a lot still to learn in that space, but I guess we've played AI more from. It's a bit like the gold rush, right? You don't want to necessarily be in gold, but you want to be selling the picks and the shovels, is what we say, to the miners. So we've been in data centers, we've been in the chip makers because they are benefiting from the whole AI hype. To invest in AI directly at the moment, it's still a bit uncertain. There's certainly a lot of companies out there that you could invest in, and we're certainly researching those. But our stance at this stage has been more in that sort of support network to AI whilst we learn more. And look, we're always looking for, as I said, the next winners to be able to pick those early and get capital into those, get our clients' money into those, and then ride them up. Whilst the rest of the market waits to discover them and then starts buying, and we can start selling to those sort of latecomers, if you like.
Yeah, and then you kind of talked before, James, about pulling some of the funds back into cash. Why would you do that? Why did you ask that question? For the listeners, I just want to drill a little bit into that as to why you would pull cash out of your active investments into cash.
Well, I think the big part is going, if you're paying for an active manager, you're going, what am I seeing at the moment? And do I feel like my cash position, I know that at certain points, Milford's cash position has been quite high and then it's dropped quite a bit, right? And that's pretty much we talk a lot here around, the average person should not be day trading. They should not be trying to time the market. It's all about time in the market. But if you've got a team of 250 people, that is essentially the aim of the game, right, Murray? You are taking you're taking positions on, should we be holding some back? How are we feeling about things versus, what's going to happen next?
Yeah, well, and sometimes it's about managing cash flow, right? So for KiwiSaver in particular, we've got money coming in every day as members transfer to us, and then our existing members are making contributions. You can't always get all of that money invested, particularly if the market's at high valuations like we see now. So we might actually hold some of that back, not because we want to raise the cash levels, just that we don't see a good place to put that money today, but it's sitting there ready to go in, in the next week or month or whatever it might be. So there's one part of the equation is managing the cash levels. The other piece, though, is you're right, Michael, is KiwiSaver in particular, it is a long-term investment, so you don't really need to worry about the ups and downs of markets, but we do need to manage the cash levels, and we will have a view on cash today versus COVID, for example. When there's a shock to markets, you do want to try and protect the downside, but primarily we want to be invested in markets so that we're benefiting from the growth. And as I said, we're not invested in markets, we're invested in companies. So it's a collection of the exposure to those companies, which is the equity exposure of the fund or the bond exposure of the fund, and then the cash we use as a buffer.
Can I just ask about when COVID hit? So you had a really long run from 2008 to 2020 where markets were really strong, but something like that happens that is a complete surprise and there's no planning for it. Just talk us through what that time was like.
Yeah. It was fascinating. I mean, I've been through a few cycles in my 30-year career. That was one out of the bag. And look, with the benefit of hindsight, you can always look back and go, well, maybe we should have seen that better or understood that better. But a pandemic is something nobody had dealt with before, not in modern times. We've dealt with. You can deal with shocks to markets where there's things like, a GFC, and you could kind of see that building. You could see the credit bubble building. Or if there's an event like, an election, like we've seen in the US, right? It builds over a series of months and it impacts the market. But the pandemic, we were starting to get signals out of China early on, and you start to do some research. We're very fortunate. We've got Dr. Deb Lambie on our investment team. She's actually a medical doctor, but she's also a very good investment analyst. analyst. And so she understood this whole pandemic thing and COVID very deeply.
Yeah.
And so she was actually able to get on the phone and speak to some of her colleagues and ex-colleagues around the world and go, what do you think about this? What are you seeing? She was making calls to people in hospitals in locations that were already being affected by the pandemic. And she was able to feed that back to the team and going, look, this is what we're seeing. And then, of course, the rest of the investment team, we're getting information all the time from economists and brokers and people that are in the market that are talking to companies at the front line. And then you can make a decision, right, what do we want to do? So some of the things that we were doing is, right, okay, the world's shutting down. We don't want exposure to airlines. We don't want exposure to tourism. We want more exposure to medical companies and healthcare companies, and that's exactly
pharmaceuticals.
Yeah, exactly. And so, as an active manager, you can do that, right? You can pivot from airlines and tourism to healthcare and medical and pharmaceuticals. With a passive strategy, you're exposed to all sectors, all companies the whole time. You can't change that. You can't adjust that.
Yeah.
So look, it was a really interesting time. It was a lot of hard work. Ironically, though, as we saw, it was a deep collapse in markets in March as the world kind of had this shock. What's going to happen? Nobody knew. Were we all going to die? What did this mean? But then there was a very quick recovery in markets as well. And so again, that's where, as an active manager, you can pull some pretty big levers pretty hard to be able to shift between that cash and exposure to the market. So we were able to very quickly get reset. And of course, 2021 was one of the best years on the market.
Yeah. It was funny. I remember when I was flying back to New Zealand and we landed in Bangkok during COVID, and there was just planes parked up like all down the side, like rows of planes down the runway. I just remember looking at it and being like, holy crap, we are in trouble here.
Yeah, no, it was an unbelievable time. I mean, you just think of it now. If you were telling somebody a story that just arrived on Earth, we had all these planes parked up everywhere. We were shut down. We were in our houses for months. People would go, that's crazy.
Yeah. I guess the other, on the active management side though, what if this isn't as big of a deal as people are making out to be? And what if we're wrong and, we're moving out of all these investments, and then, there's been examples in the past of kind of, pandemics that haven't turned into global pandemics, and the market goes by, you guys take a position, and then you look back and go like, well, that was a mistake.
Well, that's where you have to sift out the hype from the fact and the reality, and that's where your in-depth research is going to help you do that. Because you're right. I mean, every day there are sensational headlines in the newspaper, and if you reacted to every media report or every headline, you'd never make a decision, or you certainly wouldn't make much money. So you've got to trust your process, trust your research, and then make your calls. And you've got to live by them. Look, we don't get every call right. No active manager does. You do get some wrong, but you got as long as you get more right than you get wrong, then you're going to be fine.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below. It is always interesting when we're talking to people, talk to a ton of customers, and they're always talking to us about sharesies, right? I've made so much money on sharesies. And I'm like, do you have any idea what you're investing in apart from like the headline, like Fisher and Paykel? I'm like, do you have any idea the fundamentals of the business, the board, what's the price to earnings ratio? What does that even mean?
Well, here's a funny story, right? So during COVID, my 18-year-old son sets up a Sharesies account and he puts some money into it, and I didn't know he'd done this. And, we were just, because we're all working from home and he's at home, he's not at school. And in the kitchen one day, and he goes, "Oh, Dad, I've set up a Sharesies account." "Oh, okay. What do you put in there?" He goes, "Oh, well, I bought some Air New Zealand because it was cheap, and I've bought some A2 milk because it looks like it's a really good company." And I went, "Okay, why did you make those decisions?" "Oh, they just look good, and my friends were talking about it." Talked to him a year later. "How's your Sharesies portfolio looking?" "Not that good." He didn't. Nothing wrong with Sharesies. It's a great platform, but him as an investor, he's not an investor. And he made some bad calls.
But the great thing about that, and what I do like about Sharesies, is the education side. Like, imagine if a platform doesn't exist like that, or we're back 10 years earlier. How much longer would it have taken your son to learn those lessons and to go, I should not be picking my own stuff. I should be, outsourcing this to somebody else. Awesome lesson to learn, while you're still in school.
Yeah. No, I mean, Shears is a great platform, and COVID was really good for them because there was a lot of people doing exactly what my son did at home, nothing to do. Oh, well, I'll set up a portfolio and trade a bit of money. And it was great lessons.
Yeah. And then in terms of the way that Milford operates, you've talked about the research and the team and, kind of the way that you guys perform your investments. You've got to consistently outperform the market, to justify the fees and especially compared to the index guys. How do you guys do that? What does that look like? And what's type of the ethos that Milford has behind that?
Yeah, well, you did right. I mean, why would you pay an active manager if they can't beat the market, right? And look, there is a lot of research out there which says active managers can't beat the market. We're very aware of that. And look, that is probably true in some of the very deep and efficient markets like the US and some of the European markets where, there's a lot of information out there. They're very liquid and deep markets, and it's probably harder to beat the index. In New Zealand and Australia, we can get very close to companies. We can, like any company on the NZX, our team could pick up the phone today and have a conversation with the CEO, the CFO. We can go down and meet them. We can talk to them. Obviously, we can kick the tires pretty hard. We can get a really strong picture of the business as well as the competitive environment and, talk to customers and all that sort of stuff. So you can build up a really, really strong picture. And so there is actually evidence which shows active managers in less efficient markets like New Zealand and Australia can outperform. And, there's research done by Melville Jessup Weaver. They do some very good research. They're an asset consultant, and they produce a quarterly report. And it shows that active managers have performed, in particular New Zealand, Australia, outperformed the index and the market.
What about when it comes to so that's interesting in terms of the Australia New Zealand component, active versus passive, but you still look at it and there's active managers who do not outperform the market and who are pretty far behind. And you look at the Morningstar report that comes out on a quarterly basis and stacks all of the KiwiSaver providers, and Milford since 2007 has this their numbers. You look at the stats around active versus passive and the probability of outperforming the market over the long term. Coming back to Mike's question, how does Milford continue to outperform?
Well, actually, if you look at that Morningstar report, the September quarter one just came out, and if you look at in the growth category over the last 10 years, the top 4 performing funds are all active managers. And over 5 years, I think it's the top 3 are active managers. So, passive's done better in the last 12 months because the market's just gone like this, right? So, a rising tide lifts every boat. And so the passive funds have actually done very well in the last 12 months because they've ridden the market up. But can they maintain that? If the market goes through a downturn, as an active manager, we're trying to manage the downside, right? So it's easy, not easy, but it's easier to make money when the markets are on the rise. For us, it's about picking those individual companies, picking the winners, and managing the markets on the downside. And that's really where an active manager will earn their fees. And so for us, again, it's just a very consistent, repeatable, robust process that we go through managing our clients' money. I think one of the other big things for Milford is that we're all invested in the same funds. Every single staff member at Milford, all the investment team. We can't have our money anywhere else. And so there's quite a bit of motivation to
we got to get this right.
We've got to do well for our clients, but we've got to do well for us, and it's our mums and dads and aunties and uncles that are in there as well, because the word of mouth is a great thing, and so it's following that process, and it's picking those winners and trusting the process, and then avoiding the losers. I know it sounds easy, it's not.
Yeah. What about when it comes to I think about Milford is growing and growing, right? Got a lot of money under management. There would be an argument that it is quite hard to stay an active manager once you hit a certain size and do end up in some respect becoming a passive manager, because you have to just buy stocks and buy bonds because you've got clients throwing you money, which is why some funds close at a certain point, right?
Yeah.
How does Milford, and this is probably a little bit of a technical question, how do they stop themselves from becoming an active manager that ends up becoming a passive manager?
Yeah. You're right, particularly in a small market like New Zealand. So capacity is an issue. It's something that we monitor consistently, and we run the numbers, and we're looking at our flows, and we're looking at our expected inflows, and we've got a very good risk and performance team who are crunching these numbers every quarter and saying, look, based on our amount of money FUM now and based on what we think is going to come in the next 12 months, we, might be pushing up against the capacity in something like New Zealand equities, which is, a much smaller market. Australia, not so much of a problem. Global markets, no problem at all. Almost infinite capacity. So we do monitor that. It's true, though, that we have over time, when we were a $1 billion manager, now we're managing $24 billion, we have had to shift the amount of capital we've got offshore, and which is why we've built up a very deep and experienced team in global equities, global fixed interest, because we've had to invest more there than we used to. And so I said, earlier on, being an active manager is not just about picking individual companies. It's about picking the asset classes and what's the mix of those asset classes. So it's true. As you get larger, you do have to invest more offshore. We'll have to continue to do that as KiwiSaver grows. All KiwiSaver managers are having to do that. I think the exposure across New Zealand equities for all KiwiSaver funds at the moment is about 10%.
Yeah.
I mean, we'd love it to be more. There's another issue there around IPOs and a sort of a lack of things to invest in. But, KiwiSaver, if we can grow the KiwiSaver pot, then we can grow the capital markets in New Zealand. And there's real flow-on benefits for that.
What about as well, I look at the government talking about how they need to invest into infrastructure in New Zealand, and they talk a lot about getting money from overseas. But as we look at these KiwiSaver pots that continue to grow, I understand that the number one outcome is to deliver a good financial result for clients. But there's also the component of, KiwiSaver, just like we've seen with Australian Super, can do a hell of a lot of good. It can make New Zealand way better, make us a far better country. And you would have thought there would be a good return in there somewhere as well. Do you spend much time at Milford going, having conversations, with the government and going, are there investment opportunities from an infrastructure perspective?
Yeah. Well, there's two angles to that. Private equity. And so, we have for a very long time been investing in private equity as part of our KiwiSaver funds. That's not infrastructure. That tends to be more in, sort of growing New Zealand companies. We've been in the technology space. We've been in the education space. Infrastructure, much bigger question. Yes, Australia, you go to Sydney, you go to Melbourne, fantastic tunnels and bridges and roads and motorways, a lot of it built by superannuation money. $3.8 trillion in superannuation in Australia, 116, 17 billion in New Zealand, 17 years on, they've been going for 30 years. So we do need to build the pot. We do need more contributions. Maybe that's a topic for another day, KiwiSaver contributions. But as we do grow that pot, we could use KiwiSaver money to build some of the infrastructure projects in New Zealand. And, I know Andrew Bailey is actually actively engaging the industry at the moment. And we are having those conversations around the table with him and others around, well, how can we get KiwiSaver money to fund some of the big infrastructure projects that we do need in New Zealand? And that's absolutely a benefit that we could be bringing. Yeah,
amazing. So if someone's looking for advice around the KiwiSaver, they're thinking, I'm with this bank, they're not doing anything, their returns are crap. What should they be looking for? Who should they be asking about this?
Well, get advice. There's lots of great financial advisors out there. James is one.
Mike, I'm right here.
Yoo-hoo. I say get advice, but your average Kiwi is probably a little bit shy about engaging advice, right? So, but it is a good thing to do, and it's easily accessible. It's probably more accessible than it's ever been. You can phone James, or you can phone a lot of people now that can give you advice on your KiwiSaver. But there's a lot of information online as well. So I'd say, start doing your own research. The Morningstar report's a really good place to start in terms of just looking at after fee returns, and that's a really important point. And we talk about fees, we talk about active versus passive. That Morningstar report summarizes returns after fees. So, when I say those top performing funds are active managers, that's after fees. So does it really matter if you've paid the 1% to outperform by 1 or 2% versus 25 basis points for passive, which, passive, you're only actually ever going to get the market return less the fee. You're never going to have an opportunity to outperform the market. So do your research, start with that Morningstar report, then go maybe to the websites of 2 or 3 providers that you've identified, do your research on that. awful amount of lots of information
Yeah.
on the websites. Amazingly, word of mouth is a really good source of information. Don't take advice from your friends and family, but if somebody's had a good experience with a provider, then talk to them about that, and then contact the provider and have a chat and just see do they align with your values? Do they look like they've got a good track record? Do they provide good service? I mean, that's a topic for another day around what do you look for in a provider, but look, there's lots of advice out there. You just go and look for it through the websites, and some providers can refer you to an independent advisor if you feel like you want that independence.
Awesome.
Cool. All right. Well, Murray, thank you very much for joining us.
Been a
Very
pleasure.
interesting conversation. I took a lot out of it. We're going to do another episode with Murray where we talk about 5 tips around KiwiSaver. So make sure to check that out. The only way you're going to find out about that episode is if you subscribe to the channel, give us a review, give us a like, and we'll catch you next time.
Cheers.